All right, this is the third of 5 recordings for Chapter 11. We're going to talk about impairments. So an impairment is when the company does a comparison between the carrying value of an asset and the market value of the asset, or the expected future cash flows from the asset, and to see if there is a difference. Because if you are not expecting to be able to recover the cost over the remaining life, the asset is reported at too high of a value and you need to decrease that. So an impairment is writing down the cost of the asset, or writing down increasing accumulated depreciation, so that you aren't carrying the asset on the books for more than you expect to recoup from it. And you would test for this when you have these kind of events happening. You also are required to test for goodwill at a minimum of annually. All right, next. So measuring the impairment, there's 2 steps generally. We're going to look at a review, and then we're going to apply the recoverability test. So that's the sum of the expected future net cash flows. This is not discounted. If it passes this test, you're done. If it fails this test, you have to go out and find the fair market value of the asset, and then you compare that to the carrying value and adjust the carrying value downwards. So here's a little flow chart. Are you expecting, is there a possibility that the future cash flows will be less than the carrying amount? So we'll use undiscounted future cash flows. If they are not less than the carrying value, you're done. If they're less than the carrying value, you have an impairment and you need to measure the loss. If it's an asset for sale, you'll compare the fair market value to the carrying value and adjust the carrying value. If it's held for disposal, you do the same thing, but you have the ability to write back the impairment if the value of the asset increases over time. So you can write the asset back up to the carrying value it would have been if the impairment had never been done. Here's an example. So this company has equipment that they're going to check. The carrying value is $600,000. The expected future cash flows undiscounted are $650,000. So the recoverability test, we're going to look at the cash flows of $650,000, compare it to the book value of $600,000, and we don't have a problem here because the future cash flows are more than the carrying value, so we're all set. Now, if the future cash flow estimate goes down to $580,000, now we have an issue because the carrying value is less than the expected future cash flows. So now we got to go to step 2. So step 2, we're going to take the fair value. So they have to go out and get the fair value, and they're telling us here it's $525,000. Compare that to the carrying value. So we have a loss of $75,000 that needs to be recorded. So we will debit a loss on impairment, and we will credit accumulated depreciation. So we don't want to lose the original cost, but we will record accumulated depreciation so that the carrying value is what it should be. So the carrying value now is $525,000. All right, here's an example. So they own equipment that costs $900,000. There's accumulated depreciation of $380,000, so we have a carrying value of $520,000. The expected cash flows are $500,000 minus the carrying value, so we have a negative difference there. The carrying value looks like it's too high, so we have to go to step 2 to calculate the impairment. So when we calculate the impairment, we're taking the fair value, which they told us is $400,000, subtract the carrying value, which is $520,000, so we need to record an impairment of $120,000. And again, that's going to go to the accumulated depreciation account. Restoration of impairment loss. If this is an asset that you are using, you can't restore it. There's no restoration of impairment losses. IFRS allows them to do it sometimes. If it is an asset held for use, the fair market value will be the new cost basis going forward. So you will have to recalculate the depreciation expense per period. if it's an asset that you're trying to dispose of or that you're trying to sell, you do your impairment. Your impairment should be the lower of cost or net realizable value. And you can write the impairment back up. However, it cannot exceed what it would have been if you had never done the impairment in the first place.